Welcome to another real estate industry update. My name's Daniel Roccanti, and I'm here with Kyle Paxton. Today's topic is about the real estate professional status. This is a pretty big topic, so we're actually going to break this up into three parts. So, part one today, we're going to talk just about an overview of what the real estate professional status is, and then part two and three, we will go into more details. So, please tune in also for part two and three videos once they come out.
Daniel and I are going to try our best here in the overview to rank. This stuff gets us really excited, so it's hard to not get in the nitty gritty. So we'll do our best. No promise.
If you deal with a lot of real estate people, this comes up all the time, and just one of the better parts of the tax code. So, what is a real estate professional status? All right. So, rental real estate activity is by default a passive activity. Okay. And so rental, because they fall into passive activity, there's limitations, a whole different code of passive activity losses. But if you meet a real estate professional status, then you can treat your rental real estate activity as non-passive. This basically allows you to take these losses from your rental real estate now against other non-passive income. All right. So this is great for real estate people because now they can potentially take all those rental real estate losses against their activity where the rules kind of basically wouldn't allow it. And why was this is because about 30 years ago, they created this rule. It was kind of the wild, wild west before that. It was great times. I wish Colin and I probably wish we were more into our field back then. Yeah. But what was happening is that doctors, people with very high active income, was basically able to invest in rental real estate and take massive losses against that and pay little to no taxes. Okay. There's a huge loophole. So Congress, IRS, they all got together and they're like, how can we close this? So they closed it by basically creating passive activity losses. But there was also another side to that, and that is it negatively affected real estate professionals because it also basically limited their losses as well. So they created this real estate professional status. So that way, it didn't negatively affect real estate professionals. It only affected high income people that really were not in real estate field. They were just using real estate as a tax advantage. Okay.
Daniel, if I can pause you right there just to further demonstrate this point on kind of how how it was negatively impacted the real estate space, right? When you think about if you have a taxpayer who's developing and selling property, and then they're also developing and renting property, there was a mismatch here where the developing and selling property was treated as a non-passive activity. Their ordinary course of business, all that treated as non-passive, and taxes non-passive activity. And then rental losses driven by depreciation, some other non-cash items like that. We often see that in rental activities. The taxpayer who is kind of doing all of this as one operation, right, wasn't able to deduct those losses that were coming through from the rental activities with the income from the developing and selling activity.
That's a great point, Kyle, you make. It's just, if you're a real estate professional, you could actually have active income. You're in a real property trader business, you're, say, a real estate agent, broker, things like that. That income is still in the real estate field, but it is not passive income, which is completely different than rental real estate. Okay. So a lot of times real estate professionals, they just have a mixture of both. Okay. By meeting this status here, basically just gives you the opportunity to commingle those so that they're all under the same rules. Okay. So how do you meet this status though? Right. So, a taxpayer must spend a significant amount of time in real estate activities to even take advantage of this real estate professional, okay? You're going to have a hard time meeting needs if you have like one or two rentals, okay? So this is really for real estate professionals. Like, I spend most of my time somewhere in the real estate field, okay? So to qualify for this, as a real estate professional status, all right, the taxpayer must own at least one rental real estate. Okay. If you don't even have rental real estate, you're not going to qualify this because there's really no point. You don't have any passive income to even turn into non-passive. All right. The second is more than one half of your personal services must be performed in a real property, trade, or business. Okay. So that one, it sounds a little weird, but basically what it's saying is that if you're a full-time employee in a non-real property, trade, or business, you're going to have a difficult time meeting this. Okay. The second one is then the taxpayer must perform 750 hours of personal services in a real property, trade, or business in which they materially participate. Okay. So half their time has to be in personal services in a trade or business, and then they have to at least have 750 hours in real property, trade, or business that they materially participate, which they should easily get because participation rules are actually less than that, it's only 500 hours. Okay. But what is this is saying right here is that, okay, again, I have to have basically more than half my time something in real estate. Okay. So unfortunately, someone like Kyle and I cannot meet this status because we are accountants, which are not real property, trade, or businesses, and we spend most of our time in this. So there's no way that we can even spend half our time to meet it. Even if we met it, even if we went crazy and worked so many hours and got 750 in a real property trade that's outside of our accounting jobs, we still can't because we have a full-time job outside of this. Now, if you have a part-time job, you might be able to meet this, but just realize if you have a full-time job outside of property trade business, it'd be difficult to meet. Okay.
And to build off Daniel's point there, this has been tried a good bit in the courts, and there's good there's good precedent here that Daniel and I are a little bit dead in the water with our and so oftentimes it's been established where an accountant who works in real estate, that's 85% what I do, maybe 100% of what Daniel does. We're still not in real property, trade, or business because our work is just kind of like tangentially connected to real estate, but not actually in what you would consider I'm throwing around the word active, which I don't like because we're talking about it, but in like an active real estate business, right? And so we're a little bit dead in the water there. And like I said, there's good case law out there. Some of the fact patterns are really interesting where we'll talk about substantiation, but taxpayers trying to put together the number of hours they work per day, and they added up about 30 hours of work, which it was struck down pretty quickly. But anyway, no good for us.
So, like Kyle was saying, it's just got to be a real property trades business. It's got to be a full-time job, but that's not where it ends right there. Okay. That's just the first test. All right. Then you also have to materially participate in each of your rental activity. Okay. Your rental real estate activity. So the first test is just like, if I meet that, okay, now I still have to materially participate to get professional real estate status. Okay. And you got to materially participate in each activity separate unless you decide you want to group it together. Okay. We'll go into more details and the other parts, part 2, about grouping it together and the benefits and pros and cons of that. But just know that, all right, have to be a real estate professional. I have to get my 750 hours. I have to spend one half my time in a real property trade business, but I still have to materially participate in my rental real estate activity to even take advantage of this real estate professional. So there is a world where, I meet the first requirement. I have several different rentals. I don't group them together for whatever reason. And I materially participate in some, but not others. Okay. Well, now I'm a real estate professional in only the activities that I materially participate. Because again, the whole point of this role is you're a real estate professional. This is your job. Okay. So you should be materially participating. It's not an investment. And that's what the IRS is trying to get here. And Congress intention wise is that if you're holding real estate as an investment, it should basically have the same rules as an investment, and you can offset it against your non-passive income. Okay. Kyle, why don't you get us a little bit more into details of the benefits of real estate professional status?
Yeah, we've already touched on a good bit of these here in our overview because so much of this overlaps. And what is it? Well, here's kind of the benefits of what you get with it, right? So inherently, as Daniel's touched on a couple times, rental real estate is inherently a passive activity. And so that has been tried and true kind of again through the court system. Not a whole lot of wiggle room there. So even if I, as an accountant, get to where I'm actively participating in my rental activity, it is still treated under the code as a passive activities. So Daniel made reference to passive activity loss rules, and we see this is the biggest benefit probably of the real estate professional status, where passive activities, losses from passive activities are limited in a given year to your other sources of passive income. So myself as an accountant, my activity related to being a tax accountant is non-passive income. If I have rental losses, I can't offset that, right? Only other avenues of passive income. Now, if I can establish that I'm actively participating in the rental real estate, you can potentially deduct a little bit more, but by and large, there's still a lot of limitations there around deducting my losses from passive activities against my other sources of income. So the biggest piece of this is that it switches any potential losses from passive treatment to non-passive treatment, where I would be able to then deduct these rental losses against my other sources of non-passive income, which can be a huge deal. We see this a lot in the real estate space in the generous bonus depreciation environment, which is continuing to scale down annually. For 2023, we're at 80% and it's going down by 20%, but we're seeing a lot of cost segregations where you generate big depreciation and deductions, and real estate professionals are able to deduct a non-cash loss, taxable loss driven by a large year one depreciation deduction against their other sources of real estate income. Can be a huge deal. The other piece to this is that the not a real estate professional status, and then meeting the material participation requirement kind of above that, the two-step process that's nice and confusing, also allows you to treat the rental real estate income as non-passive. And the benefit to that is you get out of paying the 3.8% net investment income tax. That's normally tacked onto your passive income. Of course, there's exceptions to that, limitations, so on and so forth, outside of the scope of this video. But those are the two big buckets on the real estate professional status. One thing we're going to talk about a little bit more, and then Daniel, I'll let you interject here, is that for the passive activity loss conversation, really what we're talking about there is a timing difference, right? So we're accelerating deductions there. And with anything, if you're accelerating that depreciation and deduction, generating non-cash losses, when you go ahead and sell that activity in the future, you're going to have a larger gain to pick up, right? To recoup some of that benefit. Daniel, you want to speak on any of that?
I didn't want to stop you, Kyle. Once you get going, just a lot of good information. I think I'll just kind of go back a little bit over what Kyle was saying. There's kind of two parts to being a real estate professional status. And mostly it's like, okay, my losses now from my rental activity that would have been passive losses is now active. Okay. That lets me take those losses against other non-passive income, where if I wasn't a real estate professional, it would have been suspended. It's a temporary difference. It doesn't mean I can't take those losses. It just means I can't take them in the current year. They're suspended, carried forward into the future, and then will be able to be taken once I have passive income or once the activity is disposed of. Okay. And then the second part Kyle was talking about, like, well, what if I have rental income? Okay. Why does it matter? Well, unfortunately, there's a little thing called net investment tax, income tax. It's a little 3.8% surcharge, and it's on all passive income.
On top.
Yeah. So by even if I have income, okay, and my rental income is subject to this 3.8%, all right, that's a 3.8% tax saving just by getting this, okay? I don't know about you, but I like saving 3.8% of my taxes. So if you're not taking advantage of this, you're just paying more taxes when you don't have to. You're not taking the full advantage of the tax law, okay? Now, the nice thing also about real estate professional status is if you're married, okay, only one of you have to meet the status for both of you to get it. Okay, so Kyle, tell us a little bit more about that.
Yeah. So again, there's this nice confusing piece to this too, as this all goes, right? But yes, to Daniel's point, only one of two spouses, when you are married, have to meet real estate professional status to get the benefits. Now, talking about that conversation on where there's two pieces here, you have the real estate professional requirements and then the material participating requirements above that to fully convert to non-passive treatment. For the material participation rules, while I have to meet real estate professionals separately, the spouse's activity within my real estate activity is attributed to taxpayer for purposes of meeting the material participation requirement. So there's two things here. Number one, individually, one of spouses has to meet the real estate professional status requirements, and that's the more than half of the activity or 750 hours. But then in looking at material participation of specific activities within that umbrella, both taxpayers can be attributed together for purposes of that calculation. And that is regardless of whether the spouse is filed jointly or separately.
So this is great to take advantage of. Now, like Kyle was saying, you have to basically, this real estate professional status is based on each spouse separately. Okay, so that means the 750 hours, whether I materially participate, that all has to be one spouse or the other spouse. You can't combine their hours to meet this. But once one spouse meets it, you both get it. Okay, the advantages here. And why is that great? Because let's take Kyle and I, for example. All right, we're in the accounting field. We can't be real estate professionals. Well, what if our spouses are? Okay, so our spouse is a real estate professional. Well, now, because they meet it, if we had rental real estate losses between us as a family, so us and our spouses, and file jointly together, now it can be taken against our accounting income. Okay, really, really great advantage here. Even if one spouse cannot be a real estate professional, can the other one? Okay. Now, there's more important things in life, making sure your spouse is happy than forcing them to be a real estate professional. But if this is something they want to do, a really great thing in the tax advantage, that's that way to kind of still get this real estate professional status, even if you're not a real property trade business.
I don't think my wife's watching this, but I'll have to think about that next time. I didn't make that choice early enough.
I've had one conversation with my wife. It lasted about 10 seconds, and she'll never be a real estate professional.
There you go.
I will just be taking my passive activity losses on my rental properties going forward for the rest of my life. But I will have a happy wife and a happy marriage because of it. Just a few areas before we finalize here. Do know that the real estate professional status is a highly litigated area. So if you are taking this, just know that there are some red flags out there, especially if you're receiving W-2s from non-real property trader businesses, being full-time, things were going on there that's going to have a hard time making you meet these material participation rules. So in our next parts, we're going to go into a little more details about that, about what red flags could be, make sure you have good supporting documents. Did you have anything else to add on this, Kyle?
Let's get out of here. Join us for parts 2 and 3. Deep dive in material participation and passive activity losses. Good stuff.
Thanks, Kyle. Thanks for everyone for watching this video. Just like Kyle says, we got part 2 and 3 coming out. So part 2 is going to be dive a little bit more into the material participation rules. So make sure you stay tuned in, and we'll see you guys next time. Thanks.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.